Before I answer the question, let me wish you all season's greetings from AB. The fourth quarter has brought something of an early Christmas rally to markets, but there's no hiding from the fact that 2022 has been a very difficult year. The difficulties of the market were driven by sharply higher inflation, higher rates, and higher 10-year yields, leading to the fastest decompression of PE multiples in the US in 40 years. The issue, though, for 2023, we think will be quite different. If we think about the challenge of this year being multiple compression, we think that this is probably off of the table for next year. When we look at this particular chart with the 10-year yield on the x-axis and the PE multiple of the US on the y-axis, what we find is that when yields are between 4 to 6%, which we don't think yields will go back to again, will probably still lead to PE multiples staying above 15 times. Therefore, while there is still some valuation risk in equity markets, we think that the key issue for 2023 will be about earnings growth. When the issue is more about earnings, there is greater chance for an active manager like AB to differentiate by picking companies that are likely to see resilient and even growing earnings even in the face of economic hardship. What we have learned is that when the economic tides of the global economy are going out, the only market that has historically been able, on average, to deliver positive absolute returns has been the US equity market. And because the US has always been more defensive than other markets, as well as having provided the most earnings growth and the most performance, we would continue to recommend that investors maintain an overweight of US equities relative to other equity markets in their portfolio. However, we do see that because of COVID-0 policies being swept aside in China, we think that there's a very good chance that 2023 ends up being remembered as the year of the Chinese consumer. What we've also seen is that when any market opens up after COVID, there has typically been a significant positive earnings and market performance reaction. So therefore, even at a time when we have significant economic hardship in developed markets, there could be some value for investors buying Chinese equities as a contrarian trade, given how much it has gone down over the last 2 years. We have learned that in recessions, we have typically seen earnings decline from a peak to trough of 20% on average. And that does not bode well for an equity portfolio if you own companies that are going to see declines in earnings growth. However, we have learned also that certain sectors tend to be more resilient, such as healthcare, consumer staples, or technology. And we have also seen that some businesses tend to be more resilient to these sorts of downturns simply because there is much less pressure on specific industries and sectors and companies during these periods. For instance, when we look at the software and services sector, we find that even during the GFC in 2008 and 9, they were still able to grow their earnings year over year in both of those years. We would expect a similar outcome in 2023, and we would also recommend that investors look at sectors that have a lot of very high quality businesses that are very profitable, such as healthcare, and where we find there are some very profitable businesses that are now available for a much lower price than they were at the beginning of this year.
投资一定有风险，基金投资有赚有赔，申购前应详阅投资人须知或公开说明书。